Manage your risk tolerance when considering these aggressive plays. Sometimes you need to be aggressive to unlock the best returns for your portfolio. Just be smart when looking for the best stocks to buy. Target Hospitality. The company builds and operates modular housing and other temporary housing units for the employees of oil, gas, and mining companies. Nine Energy Service. After a well is finished, Nine Energy can come in and get the well prepared for production. Aehr Test Systems. Investors scurried when Tesla came out with some recent news that could hurt Aehr Test Systems stock. Arhaus. The home furnishings company seems to be immune to concerns about a recession. Assertio Therapeutics. This used to be a penny stock, but not after an amazing 6-month climb in the stock price. Shoals Technologies Group. The federal investment in an electric vehicle charging network could be big for Shoals. Direct Digital Holdings. If you have confidence in Direct Digital Holdings' growth story, then the investment could give you outsized returns. Let's dive in. Here are the 7 thrilling stocks to buy for aggressive investors. Welcome to Timely Investment Research. Sometimes finding the best stocks for aggressive investors to buy is a project worth considering. Yes, investing can be intimidating when you're looking at stocks for aggressive investors to buy. After all, you're dealing with your personal nest egg and trying to ensure your retirement or your family's future. There's a lot at stake, and you should use some deliberation when you're investing. But at the same time, greater risks mean greater rewards. The difference between being a safe investor and dabbling in stocks for aggressive investors may mean settling for a 5% gain when you could have gotten a 20% gain. I'm all for being an aggressive investor, but it's important to be smart about it. I like using a small percentage of my portfolio for stocks for aggressive investors as opposed to safety stocks. But I don't put too much of the portfolio in that basket. Many investors will tell you that you shouldn't put more than 5% to 10% of your portfolio into aggressive, volatile stocks. That comes down to your sense of risk management. After all, there's no sense in being crazy when you're choosing to be an aggressive investor, right? Here are 7 to consider now. Number 1. Target Hospitality. You could make an argument that Target Hospitality is one of the most unusual oil and gas stocks you can buy. That's because Target really has nothing to do with the actual drilling or transporting of oil and gas, but it's still an important puzzle piece. The company maintains 16,000 rooms across 31 locations for the employees of oil, gas, and mining companies. It calls itself the largest specialty rental and hospitality services company in the U.S. Its operations are in the Bakken Basin in North Dakota, as well as in the Permian Basin that includes Texas and New Mexico. Target Hospitality only has a market capitalization of $1.4 billion. But the company's been a big winner over the last year, gaining more than 360% in stock price. Analysts give a consensus price target of $21.33. That indicates another 44% upside in the short term. Number 2. Nine Energy Service. Nine Energy Service is responsible for getting a well ready for production after it's been drilled, running tubes, and sometimes cementing the casing. The stock has been on a roll, consistently beating analysts' estimates for revenue and earnings. In the third quarter, Nine Energy Service posted revenue of $167.43 million, which was up 80.3% from a year ago and beat estimates of $154.2 million. Its earnings per share of 39 cents per share was better than expectations of 16 cents per share. Nine Energy, which is headquartered in Houston, is expected to report fourth quarter earnings on March 8, and the Zacks consensus estimate is for revenue of $166.3 million. If it hits that mark, it would be a 58.3% increase from a year ago. Nine Energy Service stock is up 230% over the last 6 months. Number 3. Aehr Test Systems. Aehr Test Systems provides test and reliability qualification equipment for semiconductors. It plays a key role in a field that's becoming more important as the demand for semiconductors continues to increase. The California company makes the burn-in equipment used to produce silicon carbide chips that are commonly used in electric vehicle production. And while the company's stock saw a big drop this week when Tesla announced it would create a new power inverter that would reduce its reliance on silicon carbide, Aehr officials say they are confident the announcement won't significantly affect its market. Indeed, the company is showing strong earnings as of late, with revenue in the quarter ending in November up 54% on a year-over-year basis to $14.82 million. Aehr Test Systems is a gamble for any aggressive investor, and it bears watching carefully following the Tesla announcement. Number 4. Arhaus. As an omnichannel retailer of premium home furnishings, Arhaus is a gamble because homeowners may be less inclined to spend on nice furniture if they think a recession is at hand. But so far, Arhaus is defying those expectations. After a dip last year, as investors began panicking over the softening housing market, Arhaus is showing a lot of strength. Shares are up 90% since mid-October. Even if the company's growth begins to slow again, I have faith that Arhaus will return to high-growth mode pretty quickly. Earnings for the last year have all topped analysts' expectations, with third-quarter numbers including revenue of $320 million, which was 57.4% better than a year ago. Number 5. Assertio Therapeutics. Illinois-based Assertio Holdings is a pharmaceutical company that specializes in creating drugs for prescription neurology, inflammation, and pain management. Its drugs include Cambia, which treats migraines in adults, Indocin, which is used to treat pain and swelling caused by arthritis or gout, and Otrexup, which is used to treat rheumatoid arthritis. Assertio used to be a penny stock, but no longer. The stock price is up 137% over the last 6 months to climb to nearly $6 per share. And the consensus analyst price target is $7.38. So Assertio Therapeutics stock has a runway of 28% remaining. Earnings for the third quarter kept the good news coming. Revenue of $34.21 million was an increase of 34% from a year ago and beat analysts' estimates of $31.35 million. Earnings per share doubled expectations, coming in at 22 cents per share versus predictions of 11 cents per share. Assertio Therapeutics looks to keep the momentum going when it reports fourth-quarter earnings on March 8. Number 6. Shoals Technologies Group. Tennessee-based Shoals Technologies Group provides electrical balance of system solutions for solar energy projects. That's an interesting place to be considering the growing interest in clean energy. But I really like it for its work on developing an electric vehicle charging infrastructure. The U.S. is going all in on building an EV network, committing more than $1.5 billion to help build EV chargers that will cover 75,000 highway miles across the country. It's unclear if Shoals can profit from that business, but it's a gamble worth taking if you're an aggressive investor. The stock has been pretty volatile over the last 6 months and currently is showing a loss. But it's also showing some strong growth with fourth-quarter revenue of $90.82 million, which was up 51.8% from a year ago. Number 7. Direct Digital Holdings. Direct Digital Holdings is in the advertising technical business. Its end-to-end advertising platform provides advertising technology and campaign optimization for its clients. It helps small and mid-sized clients reach targeted potential customers on a variety of media devices. It claims to manage 90,000 clients monthly, generating more than 100 billion impressions per month across various media channels and apps. It owns 3 companies: Colossus SSP, Huddled Masses, and Orange 142. Colossus SSP is a sell-side platform for advertisers of all sizes, while Huddled Masses and Orange 142 cater to middle-market advertisers. Granted, the advertising and media markets are challenging, which is why Direct Digital Holdings is a stock for aggressive investors. If you have confidence in Direct Digital Holdings' growth story, then the investment could give you outsized returns. Direct Digital Holdings stock is up 34% in the last 6 months, and analysts give it a consensus price target of $7.38, meaning it has a potential runway of 68%. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.